Well, following that wonderful conversation, you get another one. One of my favorite people, one of the best investors I can imagine, Dawn Fitzpatrick. She is CEO and CIO of Soros Fund Management, formerly 25 years at UBS. Very curious, before we start, we were planning to talk about all sorts of things that had nothing to do with oil. Yet here we are. I wanted to start with that. How much the past 3 days have upended things or been revealing in terms of how markets have responded to this latest shock?
Yeah, so I mean, you can see the price action today where markets are definitely under stress. And when you think about coming into kind of this week, at a high level, markets looked kind of benign. If you looked at index returns, they were flat to up. But below the surface, we were seeing a pretty violent rotation. Part of what you just heard Mark talk about. So markets definitely felt a little fragile. Then we come into yesterday, and I was surprised that the market rallied back to flat. But I think the realization that investors are coming to now is this is not going to be a couple-day event. This is going to be really, really hard. And I just think market participants are dealing with an enormous amount of uncertainty. You have obviously the AI disruption. You have geopolitical risks. And I just think that under the surface there's a lot of fatigue from all of that.
We're going to get into the under the surface in terms of AI disruptions and things of that nature, but I want to start with what has been priced in so far and what hasn't in terms of how resilient the U.S. and frankly the global economy are to some sort of, call it stagflationary shock, a big increase in energy prices.
Yeah, well, you see, by the way, around the globe, you're starting to see rate cuts priced out of the market. So Friday, through December, there was roughly in the U.S. about 60 basis points. That's down now to about 40 basis points. And you obviously have seen kind of the 10-year U.S. Treasuries move 15 basis points higher. And from an economic perspective, you're basically seeing a fairly dramatic tightening of capital conditions. And I think that really is kind of worrisome on a lot of different levels.
Does it make sense to you, though, that actually that would be the response from monetary policymakers to raise rates or not to cut rates in the face of higher oil prices?
Yeah, so I think, and you've heard the U.S. Federal Reserve talk about this a little. They like to look through temporary increases in oil. And again, when you look at the impact of oil on the U.S. consumer, it's only about 5% of their spend, but I do think there's knock-on impacts. So I still think actually I would bet the Fed cuts 2 times, and I think they will look through this as long as it's contained to under, say, 3 months. But we'll see. I actually think they should also look through, in part, some of the AI boom, because whether rates are 50 basis points higher or 50 basis points lower, it's not going to impact the amount of CapEx that's going on there. And then under the surface, as I mentioned, financial conditions are tightening. I think the lower-end consumer is struggling a bit, while overall consumer feels okay. And I think it's a hard dynamic to deal with.
What's fascinating is normally when people think, oh, there are going to be rate cuts, that's yay for risk assets, risk on. The scenario you're pointing is cutting rates for the wrong reason, which is actual weakness, true stress that you're seeing get into the market, whether it's low-income consumer or whether it's these pockets of financial stress. Is that correct? Do you think that the rate cuts won't help add to risk appetite or could potentially be indicative of something more of a problem?
So a couple things on that. First of all, at a high level, I actually think the U.S. economy and the global economy is going to the recent headlines notwithstanding, is going to grow higher than expectations. I do think inflation is moderating. And again, I think rates where they are modestly restrictive. So I don't think it's necessarily like a rate cut into a disaster. I think the Fed has room to lower rates, and in the context of everything going on, I think it would be smart of them to do.
So you don't think inflation is the skunk at the party?
Pardon?
You don't think that inflation is the skunk at the party, as Jamie Dimon would say?
Yeah, I think it's going to continue to trend lower. And I think things like AI, while right now I don't think it's having any effect on inflation, I think ultimately it will.
Meanwhile, the market has been tumultuous under the surface for a while, and we've talked about, you heard Mark talk extensively about the software concerns and how much that's really impacting private credit in particular. Where are we in that washout? Do you have a sense of how far along in terms of recognizing who the winners and losers are going to be in the software shakeout?
Yeah, and I think Mark spoke to it. When it comes to private credit, we saw the Blackstone headlines overnight. I think that's going to take a while to work its way through the system. I think we're going to continue to see elevated redemptions. I think some of these structures are going to come under pressure. So in publicly traded BDCs, they're trading right now on average at about 23% discount. The private BDCs and the interval funds have to return capital at NAV. And the rotation is going to be redeem those private BDCs and interval funds and transition to the public BDCs. You'll get a higher yield even if the NAV discount doesn't close. So I think you're going to see that. And I think ultimately what happens there is it's going to put pressure for there to actually be secondary sales in private credit. And the other thing with private credit is, not all funds are created equal. Some funds have disproportionate amount of exposure to the software sector. And again, I think within the software sector, this is a structural re-rating that is deserved. So I think really doing your homework on where kind of what kind of exposures the underlying has is going to be really important. I also think investors, big endowments, high net worth are over allocated to private assets. Their private equity isn't cash flowing, and now they're going to have a similar issue in private credit. So I think it's going to be a painful 18 to 24 months.
Let's get to private equity in just a second and how it's not cash flowing and what that means in terms of just investor appetite for the asset class. How much pain is there going to be? I mean, where is it going to be expressed in the software shakeout? You were talking about BDCs and the shares. People have pointed to retail funds, and you said Blackstone, the idea of lifting redemptions to, I believe, 7.5% of the fund, saying, look, we can meet these redemptions. I mean, what's the model for how you view this proceeding?
Yeah, so first of all, I think what Blackstone did was broadly smart. I think when you look at these alternative asset managers, I think returning capital in a way that they promise to investors is going to be long-term. Short-term, it will hurt their fees. Long-term, I think it will massively aid their businesses. And I think there's going to be a differentiation between alternative asset managers who do that well and ones who don't. So I think that's going to be really, really important, keeping your promises to end investors. And I don't think memories are going to be short for managers who don't do that. By the way, if you're a BDC trading at a 23% discount, you should be selling loans and buying back shares. And the only reason you wouldn't be doing that is to maximize your fees, which is really hard to justify. So I think it's going to be really interesting to see how much people stick to kind of fiduciary responsibilities. And I do think it's going to be a culling of the alternative asset managers. As an institutional investor, do you want to stay away from private asset managers or private credit funds in particular that try to cater to retail funds? No, so to be clear, we're kind of dipping our toe and buying some of these public BDCs, the ones where we like the underlying loan portfolios. So it's kind of the opposite. We like to provide liquidity when liquidity premiums are blowing out. And I would argue that this is going to be one of those moments in time. Same thing on the secondary sales. There's going to be great opportunities there. And we're definitely going to be a buyer. We are in a good liquidity position, and kind of looking forward to a little bit of carnage in private markets. So I hear this all the time. When things start selling off or dislocating, people say, oh, I can't wait for the dislocation. I'm looking forward to buy. And then when things start getting pretty heady,
people start saying this time might be different, there's going to be contagion, and I don't know who's going to be potentially exposed. What are the nodes of contagion where you could see this become a bit more systemic and cause concern that goes beyond just the knowable risk?
So there's $300 billion of back leverage on private credit funds through banks. And generally, that leverage, while loan to value is modest, it is mostly mark to market. And those loans generally have not had a lot of mark to market volatility. And I think there's going to be regulatory pressure to start remarking those loans. And once they do that, those private credit funds are going to have to come up with cash to meet those margin calls. In most cases, they have some excess cash, but I think those cash reserves are going to run low quickly. So if you start seeing pain or scrutiny on the banks on that lending side, I think that could be a harbinger of worse things to come.
To what extent does it have a risk for the financial sector more broadly?
So, software employment as a percent of the U.S. economy is less than 1%. I think where it plays into the broader economy is where I started. It's general financial conditions, and the cost of borrowing is going to go higher. I do think the offset to that is bank regulation is easing, so banks have more ability to loan into this, and I think Treasury Secretary Bessent made this comment the other day. I don't think Washington really minds that shift from private credit lending incrementally to the banks. So I think that's a partial outlet valve.
One aspect of this is the pain. What about the gain? I mean, how are you seeing potential opportunities, not only as we see the shakeout in BDC shares, for example, but in the AI transition where it's not just going to be losers, but also will be winners?
Yeah, I mean, so even in the public software sector, there's some names that we think ultimately will be winners. The other thing on AI is you see companies who are using operating leverage to spend a lot of money on technology right now. And by the way, JP Morgan initially got criticized for this. I think ultimately what you're going to see is, JP, the Goldmans of the world, the Walmarts of the world are creating a moat relative to their competitors. They're going to press an advantage that will become very, very apparent in a year or two. And I think AI is going to play to the people who are bigger and can make those investments structurally.
How do you want to get exposed to that, right? I mean, this is sort of a question the audience just asked, which is just can you talk a little bit about your asset allocation, but in terms of public, in terms of private, in terms of illiquid, in terms of macro, I mean, how are you sort of arranging this?
So relative to other endowments, we leaned incrementally out of private equity back in like 21, 22 to give and replace that beta with public markets. Again, we might use this moment in time if things get sloppy enough to change that mix. I think in public markets, you're seeing a lot of dispersion. The rotation we talked about from kind of old world real economy that's done really well this year and away from asset light. Under the surface, there are great ways to pick winners and losers at the company level, and you're getting paid for that. So we think being in public markets, having kind of an alpha-oriented portfolio is really important. I think diversification at kind of the asset level also, even though treasuries are going the wrong way now, I do ultimately think that treasuries, will be a safe haven, and having, a reasonable allocation to government bonds is important. On the credit side, we've leaned out of a lot of credit recently, but it's really just to create dry powder for the opportunities that we think is coming.
You use the word diversification, and a lot of people have used that to mean a lot of different things over the past couple of years. In particular, whether it's not diversifying in asset classes, but diversifying in regions. And people are saying they've been going away from the U.S. and going into more underpriced markets. I'm just wondering if you think that trade's done, and we're seeing sort of the shakeout of it right now when it's tested by the potential for an oil shock.
I don't think it's done. I think what happened is asset allocators kind of got lazy over time, and coming into last year ended up way over allocated to the U.S. dollar and U.S. assets, and they're just trying to right those allocations. I think the initial move was pretty aggressive because they realized how offsides they were. I think you're going to see a continuation of that, but I think it's going to be more moderated and modest in terms of the impact. But again, I invariably think people got overexposed to the dollar and are just trying to get back on sides. But I don't think it's necessarily a repudiation of the U.S.
Well, and I want to finish up on something that you kept saying, which is that private equity just isn't cash flowing. I love that concept, but it's not giving people the capital to reinvest and redeploy in the same kind of way and to reallocate to private equity. Where is PE in just sort of its cycle, given the fact that we haven't seen exits, we haven't seen IPOs, we haven't seen the kind of monetization of a lot of these investments?
Yeah, so I think there was a lot of hope coming into 2026 that it would be the year when PE starts to cash flow in a really meaningful way. What you're seeing is the IPO market is open, but it's only open for really high quality companies. We had $14 billion in secondary and primary sales last night, but they were utilities and insurance companies. And the other interesting thing about private equity is historically, when private equity monetized an asset, you'd get like a 20% bump. Last quarter, monetizations were flat to down and I think that's a little bit giving up the ghost. On the plus side, 2026, you are going to see some mega IPOs. Unfortunately, these aren't necessarily companies held by private equity. But rumor is you'll see OpenAI, Anthropic, SpaceX all go public. By the way, to put that in context, any one of them alone would be the largest IPO ever. In aggregate, if you get 10% float, it's about $250 billion of IPO proceeds, which is more than the U.S. had in aggregate since 2022. I think that's good in a lot of ways in that it will clean up those cap structures. It gives them access to capital markets in terms of heavy spend. But that money is going to have to come from somewhere, and that's why you see like a really hard fought to get included in the indexes, which again will create natural buyers for those companies. But there's another side to that. It will mean people have to sell the other names currently in the index. And if you look at historical data, when you get a really big pop in IPOs, generally 6 months forward, the market re-rates on a multiple basis lower.
So we could expect that possibly going forward. Unfortunately, we're out of time. I could talk to you all day. That's Dawn Fitzpatrick of Soros Fund Management. Thank you so much. That was wonderful. That was awesome.